Shiv Seghal is joining us. He's president and head at Nuvama Capital Markets. Shiv, great to have you with us here on the program. Thank you very much. Just give us a bit of texture, feel of what is going on in terms of, institutional flows. What are you picking up when you speak with clients? The one theme we've been pointing out is, markets, big underperforming markets of last year getting money. At least that's what we've seen 2 weeks of 2023. And money is is being funded out of investments here. Is that what you're seeing? And what else?
So Prashant, firstly, thanks for having me on the show. Always a pleasure to speak to you guys. I think a few anecdotes here. What we have seen is that 2022 was a massive outperformance for India, right? On a relative basis, we had the entire world, entire global market selling off, and India's domestic growth-led tailwinds really helped us. What is plausible here is that 2022 was a price shock, a financial market shock, but not yet an economic shock. I think the markets may have got ahead of themselves, that it is the economic shock comes with a lag in terms of what the Fed has done, right? A lot of those effects will have a lag into 2023, and there are still a lot of unrealized risks for the real economy. I think the Fed still wants to be very clear that they're in control. Pivot too soon, the biggest question from a macro community in the institutional world is, when does the Fed pivot? What does the Fed pivot look like? Does it come in the second half? And how long does it last, right? I think there are a couple of interesting anecdotes there, because the problem is if they pivot too soon, you might set a rebound in growth expectations and inflation expectations and energy and other commodities. And suddenly the PPI goes up, the CPI rebounds, and then the Fed has to go even harder. So that might be the story for later in 2023, but it certainly feels like that's the playbook. So in my realm, I think it feels that Fed will probably hike by another 25 basis points, see how the data plays out in the next 1 or 2 quarters. But what that does is the fact that we have China reopening in the same end. You asked this question just to your previous audience as well. And I think what is important here is we are seeing in the institutional world certain reallocation of money from EM asset allocators that are looking to invest into China. And they are, we have been seeing the data every day, foreigners are selling India. But structurally, I do feel that we are in a slight of a blip here in January and February. And to remind everyone kind of watching this show that we saw a similar trend last year as well, right? 2022, when we started, everyone was talking about the fundamental value in China. And we saw money rotate out of India into China at that point of time as well. Of course, as quarters and months went by, we saw that the domestic growth story, the no alternative, everything that we talk about from an India structural long-term bullish aspects remained intact, and we saw money rotate back into India in the second half. I think we might be seeing a similar playbook right now, and it seems to me that earnings are probably going to dictate in the short term in India, and we are seeing a little bit of headwinds in terms of what's transpired. I bucket them into 3 classes, right? We have the recession fears and impact on global demand at the moment. We have the QE withdrawal with high interest rates, and of course we have the geopolitical issues from a macro community point of view. At the same time, from the domestic scenario, what the few headwinds that we can talk about going into this year is, of course, we have 9 large states, 5 large states, and 9 political states going into elections. We have general elections next year. We have potential re-emergence of imported inflation due to high commodity with China and the global growth opening up, right? And slowing demand scenario in India, which I don't think plays out, which strategists are calling about. But coming back, I think a lot of participants have come here and talked about the fact that manufacturing shift is happening in India. We have unlevered balance sheets. It's the beginning of the private capex cycle. There is massive investment in infrastructure development, both from the government and private sector. And most importantly, the fund flows into emerging markets as they happen. So there are 2 legs to it. The first derivative is as China continues to see the first leg of the investments, we will of course see the outflow. The second derivative is as EM bucket starts to see more money. MSCI India, our share has gone from 9 to 14.5%. So we will be the second derivative benefit of that. So I'm not that negative with China reopening. I think it's actually very positive for India and for global growth that China does reopen. It's a very large economy for the last 3 years that has been shut. And I do feel that it's about time that we do see some impetus from China an added benefit to global growth from that perspective.
Hi, this is Rima here. This year is also going to be unique in a way that US and Europe is likely to slow down and China is going to do very well. So typically in the past when we've had recessions, all the global economies have fallen in tandem. But this time you've got two large economies which are going to be moving in diverse directions, in different directions. So this year is going to be pretty unique. Shiv, but before that, numbers coming in from Sign. This is a mid-cap IT company and it's not bad at all. In fact, it's beaten street expectations. So this would be the second number from the IT earnings pack, which has not been as bad as what the street was fearing. The revenue growth, we've got only the rupee revenue growth right now. We do not have the dollar revenue or the constant currency revenue growth, but the rupee revenue growth is 16%. Margins have expanded by more than 300 basis points on a quarter-on-quarter basis to 13.2%, and profits have practically doubled. The PAT has gone up 97% on a quarter-on-quarter basis. One reason why you are seeing such very large growth numbers in the case of Sign is because of acquisitions. There were 4 acquisitions that Sign did last year, which have all culminated, and the full benefit of that is coming through in Q3. So the organic growth is going to be, what, 3-4%, thereabout. But given the acquisitions that the company has done, the top line is looking very good. And another reason why the profit jump is so much higher at 97%, that's because in the prior quarter, there was an exceptional loss. So one reason is the margin beat, and the other reason is the fact that last quarter, the profits got depressed due to an exceptional loss. Shiv, wanted to get your thoughts in on IT. Not as bad as what the street was fearing, whether it's TCS and now even Sign.
So, Rima, I'm actually very bullish on the IT sector. I think, the sector itself has been consolidating. Of course, there was a de-rating in growth stocks globally, right? I mean, of course, because as interest costs went higher. But from an India perspective, I think there is a couple of combination of factors, right? One is we are seeing margining or bottoming out, right, in the entire IT space. I think it's a healthy dividend yield play sector as well. There are cheap valuations given that it's been in consolidation phase for the last 2-3 quarters. And additionally, from a macro standpoint of view, I do feel that there's a potential INR weakness coming that could be a tailwind for the sector as well. Let's not forget that INR was probably the best EM currencies for 2022. And there is a lot of the most important element that we didn't talk about is the fact that the order book even from TCS, even from Sign, and I think even Infosys reports later today, I think the entire IT pack is talking about the order book being very, very strong, and the margins bottoming out is probably providing a very good tailwind to this sector. So I'm actually going into this year quite bullish on the IT sector for sure.
All right,
and, you also made a point on the mid cap and small cap space. Just one anecdote there. We all know the stats. Of course, the fact that Indian mid cap, not just IT, but Indian mid cap space has held up really, really well. If you look at what happened in the US and global market, and just take Russell 2000, which is the mid cap space in the US, that was down 22% last year alone, right? There are a couple of points which I don't think people understand to that extent. There is a tectonic shift that's happening. There is a market share consolidation happening from the unorganized to the organized sector that's been in play in India for the last couple of years. This shift benefits the mid caps far more than the large caps, as small shifts in the market share for the mid and small cap companies can result in much stronger demand and profit bumps, right? The other anecdote, and the data actually just came out recently, which I want to share, is that if you look at the amount of inflow that we are seeing from small and mid cap, from the SIP flows that we see. So in December, about $880 million came into equity schemes last month, right? And if you look at what the share of small and mid cap was $500 million, right? That's about 60%. And what people don't realize is, I think, we topped out in Jan of 2018 in this particular space. We have been transitioning to a much healthy balance sheets, much more robust set of earnings. And I think that interplay is about to kickstart again. I remain structurally very bullish on India per se. And I do feel, I want to go on air about it, I think in the next 3 to 5 years, you will see an equity super cycle in India for sure. Of course, it's going to have its volatility along the way. But for me, at least for this year, I think we're going to see the small and mid-cap space do exceptionally well.
Very valid point, Shiv. Thanks so much for stopping by and giving us your view on the headline index, on how you see India versus China, as well as the point you last made, that the breadth of the market could still do well. even in volatile scenario. Thanks so much for joining in. By the way, it's expiry that's going to play out, and we're holding above that 17,850 odd mark. The 17,800